Good evening, everyone. Time for another silver update. This is the weekly chart of gold provided by netdania.com. You can click on the link below. Now you can see here this flag formation that we've been pointing out for a while has clearly resolved to the upside. There's no question about that. Now, we don't hear the people who were talking about gold being a bubble, gold being a top, gold crashing, and same true of silver, etc., because it's very clear that that's not the case. So we're forming up to do another one of these, and if you look at the MACD, and a lot of people have asked me recently about the MACD indicator. I've explained it in previous videos. It's a moving average crossover divergence, and you can go very deeply into the theory of why things work, etc. I really don't look into those things because for me it's the difference between inductive and deductive logic. I'm not really interested in examining the deductive logic of why this works. For me it's just simply an inductive thing. And for those of you that aren't familiar with that, deductive logic derives necessary principles and reasons for things based upon logic. In other words, these things must flow from the prior principles. For me, that's not important. What's important for me is inductive logic, the fact that it works. So, for example, if you drop a ball and it falls to the ground and you produce a law, the law of gravity, that's an inductive law. In other words, you don't know why it happens. No one to this day has ever been able to explain gravity and why it happens. It just does, and it always does. So that's an inductive law. That's the same way with this MACD. It's a trending indicator, and it just seems to work. So I don't really question the logic behind it. I just simply use it. So hopefully that explains why I use this indicator. Now, this indicator for gold, you can see, has crossed into positive territory. It's at +7 now. Silver's a ways behind it, but you can see that the past time when we crossed into positive territory, it was at a very steep slope. We're actually coming close to the steepness of that last crossover. As we cross over, this zero line is actually one of the strongest points that we can do. So it's quite possible that gold could run here. You can see that 1800 is the next big resistance point, and it does not appear that this old support line down around 1000 is going to be revisited ever, and that's probably just going to hold until the currency is changed. Now over to the silver chart. The MACD is a little bit different here. Now, as I pointed out in the last few videos, it's quite possible. I actually pointed out when I did the video that said that the rally has begun. That was back around the 20th or 22nd of August. You can find that video. And you can see the strength of the rally now that we've begun to run. And as I said in the past few videos, we could take out 32, 34, 36, and even take out this 3750. There's just no predicting how fast this can rise when it really starts to rise. And of course, all of these prices, even 49 and below, are so undervalued on a relative basis when we look at the price of other things and what's going on in the economy, that a price shoot in days that would take us above 50 would not even surprise me. But it's clear that we could move to 36 and through 3750 in the next week, and that's not going to give you a lot of time to stack, but we're going to be looking at the cross of this zero line. Until we correct, we may be looking at just very rapid moves in the price of silver. So the last buys that I pointed out, of course, those are in the money immediately, and as I said, you may not get a pullback and a chance to stack. You may have to stack on the way up. It's very clear here when you look at this price move that happened with QE2 that it just went straight up. I actually stacked some silver right here at 25. Other than that, I just watched it run because the run was so crazy. This run here could actually be even more crazy than the last one, and we could go up to $75 in a very short space of time. So let's get over to the questions. There's a number of questions to look at, and so I'm going to go through them fairly quick before I get to the topic of the night. First one is mathematically impossible. This is from Molecular. Why is it mathematically impossible to continue the debt-based currency system? While I do believe it's impossible to continue this system for other reasons, I don't quite understand the argument about being mathematically impossible. Mathematics doesn't dictate the debt has to be paid back in full eventually, does it? I understand there is never enough money to pay back all principal and interest. This can be derived from the system money creation, but isn't it possible to just pay back old debt with an ever-increasing amount of new debt? I just fail to see the mathematical impossibility of kicking the can down the road in perpetuity. Math has enough zeros available for us to use. Well, in theory, that's correct. They can continue to expand things, and the inflation that we're seeing now in the money supplies, I will say money supplies because this involves other currencies besides the dollar. Recently, the Swiss pegged their currency to the euro, and we've got the Japanese yen. We've got these other currencies. The Chinese currency is kind of the dark horse in this thing. So it is quite possible that they could just continue to print, although that does have real world repercussions, and the biggest of those being tremendous rises in the price of precious metals as people see their savings being destroyed. So it can't go on forever in the sense that as it goes on, more and more people wake up to the fact that their wealth is being undermined and being diluted, and more people begin to move their money into hard assets. And as that happens, you tend to get an explosion in hard asset prices, and they quickly become uncontrollable. So in theory, yes, you can expand the money supply indefinitely, but there's a lot of things involved. You have to get every nation in the world on board, and that's, in my opinion, not going to be the case. I think at some point the Eastern powers are going to pull the rug out from underneath the whole thing, and I think they're going to do that when they've accumulated about as much physical metal as they think they can get their hands on, without the LBMA and the COMEX and others shutting down on them. Once they see that they've accumulated pretty much all they can get, then I think they're probably going to pull the plug and stop participating. And that gets to an issue that a lot of people have asked about. Why do all these countries continue to dilute their currencies? And the stock answer is that they have to keep their trade going, but that's not necessarily the case. It could be that just one country could fix their currency to a hard asset and let it rise in value, and then that could be a rush towards that currency, and that would quickly become one of the most valuable currencies in the world. I suggested in the past that Iceland might want to think about doing that, but there's a number of other countries that could do that. So you have to have everybody in line, and you have to have everything working, and you can't have anything break free or break loose, or the system becomes unstable very quickly. Next question, silver possession at home. This is actually an addendum to the one that was asked earlier, and this is where George Silver points out that the underwriter for Sprott is Morgan Stanley. I don't know. I haven't investigated that. It wouldn't surprise me. If you're involved in anything that involves money, you're going to have to deal with one of these big banks. But let's get to the main question, silver possession at home, from George Silver. Dear Brother John, a number of people writing about silver advocate, quote, if it's not in your own hand, then you don't have it. As someone who is well over 10,000 ounces of silver, I find this statement puzzling. Perhaps you could put your very good and analytical mind to the task. Obviously, banks and safety deposit boxes are the last places to store silver. If you store at home, then you have the possibility of being robbed. You will also have difficulty in transporting your silver out of the country. You'll also probably find it difficult to sell a large amount quickly. People like Turk, Gold Money, and Maloney Bullion Vault offer to store your precious metals. Your metal is stored in vaults separate from the banking sharks. You also have the ease of selling and buying, plus you can leave the country without having to worry about transportation of your silver. Can we trust Sprott, Turk, Maloney, and Bullion Vault? So, very good question, and I don't know the answer to that question. Of course, all of these aren't going to be tested until everything hits the fan, and then you're going to find the answer, but if the answer is no, it may be too late. So, the best advice I could give on this is that you may want to diversify. You may want to diversify amongst, say, 6 or 7 different places. Perhaps you want to have some in a safety deposit box. Perhaps you want to have some buried out in the hills. Perhaps you want to have some with James Turk, Mike Maloney, Bullion Vault, and you just don't know until things really fall apart which of these is going to be reliable. I have no reason to think that Sprott, Turk, and Maloney aren't reliable. From everything I've heard and the people I've talked to and the people that use their services, including myself, they've been able to withdraw and add to their accounts and take delivery without any questions or problems. But then again, we're not in the crisis stage. We're not in the musical chairs point where the music stops. So no one can know the answer to that question. We're going to find out, though, definitely in the future. Next question. New manipulators after JP Morgan. John, I've thought a lot about what would happen to the silver market if we experienced the perfect storm that would end the silver manipulation. If we were to see the price of silver soar to $500 an ounce, I wonder if we would begin to see the rise of new manipulators, the bullion dealers. Every bullion dealer would know that most who are selling bought their silver for less than $40 an ounce. Why buy their silver at $500 when $250 an ounce would still provide a nice profit for those selling? What would stop the dealers from expanding the spread between the bid-ask? In other words, when you buy the bullion dealer silver, you pay spot $500, but when the dealers buy your silver, they get it at wholesale price of $250 an ounce. To me, this would be just another form of silver price manipulation. Am I wrong to come to this conclusion, or is there a policy that prevents bullion dealers from doing such a thing? Thanks for the insight you provide. I've learned much about charting through listening to you than any other way. You've expanded my understanding. I'm grateful for your tireless efforts in helping us all navigate through these uncertain times. Well, as far as I know, there's no regulation that would, or policy that would prevent that from happening. The main thing that would prevent that from happening would be the free market. If people were actually getting only $250 an ounce for their silver while it was being sold for $500 an ounce, I myself would get involved and do $300 rather than $250 to get a bit of that action. And I know there's a lot of other people who would as well. So competition in the marketplace is always going to make sure that this is not the scenario that will occur. Now, it may be in a black market situation where this happens. We don't know. We don't know what the future laws are going to be. We don't know if the tax rates are going to become prohibitive and force a black market. We just don't know any of these future things. But we do know that there are always going to be markets. And if they regulate the free market out of existence or over-regulate it so it's not useful, then of course black markets spring up. We've seen black markets all over the world. If you read one of the best books you can find on the issue would be Investment Biker by Jimmy Rogers. And if you read that book, he traveled through every country in the world on a motorcycle. And the first thing he checked when he crossed a border was the black market to see what the currency was going for on the black market as opposed to what the official exchange rate was at the bank. that told him immediately what the state of the currency was and what the state of the government was. So these things always exist. They will always exist. The governments will never be able to prevent black markets. The soldiers themselves, the government officials themselves are involved in these black markets, and you can see it in Greece. If you travel anywhere in Africa, it's the case. So there will always be black markets. There will always be free markets. Of course, black markets are free markets. So it's highly unlikely that this situation will develop just simply because of the market. So let's go to the main story of the night, and that's going to be biflation. That's the scenario that appears to be occurring here, and I'm going to show you that in a number of charts here. But let's read the Wikipedia explanation. Biflation, sometimes mixflation, is a state of the economy where the processes of inflation and deflation occur simultaneously. The term was first introduced by Dr. F. Osborne Brown, a senior financial analyst for the Phoenix Investment Group. During biflation, there's a rise in the price of commodity earnings-based assets, inflation, and a simultaneous fall in the price of debt-based assets, deflation. The price of all assets are based on the demand for them versus the volume of money in circulation to buy them. With biflation, on the one hand, the economy is fueled by an overabundance of money injected into the economy by central banks. Since most essential commodity-based investments, food, energy, clothing, remain in high demand, the price for them rises due to the increased volume of money chasing them. The increasing cost to purchase these essential assets is the price inflationary arm of biflation. With biflation, on the other hand, the economy is tempered by increasing unemployment and decreasing purchasing power. As a result, the greater amount of money is directed toward buying essential items and directed away from buying non-essential items. Debt-based assets, mega houses, high-end automobiles, other typically debt-based assets become less essential and increasingly fall into lower demand. As a result, the prices for them fall due to decreased volume of money chasing them. The decreasing cost to purchase these non-essential assets is the price deflationary arm of biflation. So let's look at some charts. Of course, the first thing we want to look at is the big news today, and that's the unemployment figures. This is a chart on zero hedge, and this is the labor force participation rate. Now, we know that the official unemployment rate was reported as going down to 8.1%. One would expect that to be bullish for stocks and other things because employment is improving, the economy is improving, everything's improving, and things are looking up. That's exactly the reaction we saw from the markets, but not for that reason. What the markets actually saw, they saw through that number, and they saw this labor force participation rate number collapse to the lowest it's been since January of 1982. And what that indicates is that QE3 is now predicted as more than a 50% possibility, and therefore stocks, gold, silver, oil, everything, almost everything, rose today with this labor force participation number. This is very important because, as I pointed out before, the key is when you have a democratic system where people can vote themselves money from the Treasury, then the key issue is always going to be how many people are pulling the cart and how many people are riding in the cart, and when do we reach the point where those who are pulling the cart rebel and simply stop pulling or jump into the cart and try to get a free ride themselves. We're rapidly approaching that point with 63.5% of the population in the labor force and the others not. You have to remember that a lot of these that are in the labor force are part-timers, so we may actually be below 50%. 50% riding for free and 50% pulling. At some point we cross the Rubicon and we reach that point where it doesn't work anymore and the cart is simply stuck and no one goes anywhere. Now, another chart that is indicative of some of the biflation that we're seeing is the natural gas price. You can see that natural gas is down from a high of approximately 14 to where it is right now, about 2.7. That's about an 80% collapse in the price of natural gas. That's a phenomenal drop, and it is surprising to me that we don't actually have some substitution going on. I don't know the mechanics of it and what's involved to have natural gas engines or natural gas power. I know that some of your backup generators can run off of natural gas. It would be interesting to see if any of you who have natural gas generators would find it cheaper to actually just run off the natural gas generator than buy your electricity from the power company. But nevertheless, you can see the price of natural gas has absolutely collapsed. The other factor involved here that we have to keep an eye on, and the price of oil is something we want to look at here, is rallying a little bit. It's not rallying strongly, but we may get into a rally stage. You can see the resistance up here. There's a number of points, about 115 and about 110. But the price of oil is fairly strong, and the price of natural gas is very weak. So the other factor that we need to keep in mind is whether or not it is a domestically produced product. If it's a product that needs to be imported, that means that dollars have to be converted, or in the case of oil, obviously we're in a petrodollar system, so we're still able to buy it in dollars. And the question is, as a FOA type of analysis would indicate, are the people who are selling oil willing to take green pieces of paper, or are they going to try to convert those pieces of paper into gold or something that's worth something ultimately? So it may be a factor that natural gas is primarily a domestically produced product, while oil is something that has to be imported. That might be the explanation for why there's this divergence. Now, another divergence that we see here, of course, is the Baltic Dry Index, and this is a very important indicator. This is the price of shipping, and you can see that we had a complete collapse in the BDI, all the way from about a high of 12,000 down to around 800, I believe it was. Actually, we're talking about 600, and you can see we're coming back down to test those lows. So this recovery, and I pointed out before, and I'll have to do a video on the topic because it's such a large topic just alone, but I'll have to do a video on the topic of the recovery. We see from the press ambiguous statements about the recovery. Oftentimes you'll hear about the recovery, but then you'll hear about how we're not recovering, or how the recovery is so slow. For us to be a good 3 years after this spring of 2009 was the bottom of the stock market, and we're a good almost 3.5 years past that point, and of course the official end of the recession that was announced was in June of 2009, so we're now more than 3 years past that point, and yet they're still talking about recovery and how weak the recovery is, when, as Jimmy Rogers has pointed out, we're actually ready to head into another recession just based upon the normal 4 and 8 year cycle of the economy. So these charts are clearly indicative of a biflationary scenario that's going on. The BDI is ridiculously low. The natural gas price has collapsed, and the labor force participation rate is nearing 30-year lows, and that is indicative of a collapsing economy that has not recovered at all. So with all of these going down, we have the silver price going up. Silver is rallying very strongly. Like I said, it would not surprise me to see silver cut through 34, cut through 36, and even cut through this 37.50, which would leave very little resistance between there and that $44 price, and then ultimately the $50 price. And once we get through there, I think we're going to rocket to 75 is my projected target. I'm not going to make predictions based on dates because I've gotten them wrong and gotten a lot of heat about that. But I do think that when we cut through 50, 75 is going to come very fast. And we'll talk to you next time.